Open a Forex chart and you'll met with a wall of noise. Price fluctuations, volume spikes, and red and green flashes moving in every direction. Traders often get lost in that data. To survive the volatility, they look for a map, a system to navigate the noise and find a reliable place to enter the market. That is where Forex indicators come in. An indicator is a strict mathematical formula. It takes historical data, like past price action, trading volume, or open interest, and calculates an average or a momentum score. Marketing pitches often sell these tools as crystal balls that guarantee winning trades. The reality is much colder. They provide a statistical probability of what the price might do next, based entirely on what it has already done. When a trader forgets that distinction, they get into trouble. Treating a mathematical probability as an absolute certainty is the primary cause of drained accounts. Because traders hate uncertainty, they naturally try to eliminate it. If one indicator gives a decent probability, they assume 5 indicators will provide a sure thing. So they start stacking tools on top of each other. But adding more layers of supposed clarity obscures the baseline data. The more tools you add to your screen, the harder it becomes to see the actual price movements you're trying to trade. Take a look at this split screen. On the left, you have a clean, readable candlestick chart showing clear price action. On the right, that exact same chart is buried under neon bands, intersecting trend lines, and bulky histograms. This overloaded state is known as indicator soup. When you have this much competing data, it inevitably generates conflicting signals. One line tells you to buy, while a histogram at the bottom suggests a sell. This is the central trade-off of technical analysis. Increasing the volume of information directly degrades the clarity needed to execute a trade. To avoid that trap, you have to evaluate the tools you are using. Every indicator falls into one of 2 categories, beginning with the lagging approach. Lagging indicators follow price action. They wait for a move to occur, measure it, and then confirm that a trend is already underway. This chart illustrates a moving average, which is the most common lagging tool. You can see the erratic, jagged daily price path in the background, with a single, smooth line cutting right through the noise. By averaging out the closing prices over a set period, say 50 days, the line gives you clear visual confirmation of the broader market direction. But that clarity comes with a structural flaw. Because the math requires historical data, a lagging indicator will always signal your entry late. By the time the moving average confirms a downtrend, the price has already dropped. You miss the initial burst of the movement. Using lagging tools is a deliberate choice. You're sacrificing early profit margins in exchange for the safety of knowing the trend direction is confirmed. On the other end of the spectrum is the aggressive alternative, leading indicators. Instead of waiting for confirmation, these tools attempt to predict price reversals before they happen. Most leading tools are momentum oscillators. They measure how fast prices are changing to identify when a market has reached an unsustainable extreme. This is the Relative Strength Index, or RSI. As you can see, it's a horizontal chart scaling from 0 to 100, with specific zones highlighted at the top and bottom. When the RSI line crosses up into that red zone above 70, it suggests the currency pair is overbought. The math indicates buyers are exhausted, and a downward price correction might be coming. However, leading indicators frequently generate false positives during high volatility. A currency pair can remain mathematically overbought, continuing to climb, far longer than your account balance can survive the drawdown if you sell too early. Leading indicators offer the strategic advantage of getting into a trade early, but they require the trader to accept a mathematically higher risk of failure. Intermediate traders often try to eliminate the weaknesses of both categories by combining them. They hope to use lagging tools for confirmation and leading tools for timing. In practice, this often leads to a stalemate. You will frequently face scenarios where your RSI momentum tool screams to sell, while your moving average trend line confirms a signal to buy. This chart plots the relationship between the number of tools you use and your ability to make a clear decision. On the horizontal axis is the number of indicators. On the vertical axis is your signal clarity. The peak of this curve is the actionable zone. Your highest level of clarity maxes out at exactly 2 to 3 indicators. Past that peak, the curve drops off steeply into the bottom right quadrant, a state of analysis paralysis. Introducing a fourth or fifth indicator mathematically guarantees that you will receive contradictory data points in real-time trading. The pursuit of perfect multi-indicator confirmation backfires. It costs you the confidence required to pull the trigger on a trade. Escaping this trap requires stripping the chart back to need an indicator minimalist strategy. This decision tree outlines a conflict-free system. Choose one trend tool, like a moving average, and one momentum tool, like the RSI. Ask, do they align? Limiting your inputs prevents constant second-guessing. The rules are binary. If both tools align, execute immediately. If not, wait. Operating this way requires discipline. You have to accept that a minimalist system will still produce false signals. Instead of adding more indicators to fix the system, you rely on stop losses for protection. Chart curation has a simple standard. If an indicator is not actively breaking a tie or forcing a concrete decision, it must be deleted from your screen. If you were just starting out, your immediate next step is to validate this stripped-down system in a safe environment. This is what a professional trading environment looks like. Notice the clean interface and the complete absence of overlapping data, just price action and 2 distinct lines. Take this 2-indicator setup into a demo trading account. You need to observe firsthand how these specific tools react to live news events and sudden market shifts. This practice phase protects your capital while you work through the learning curve of managing opposing signals and trusting your stops. Long-term success is built on the disciplined, consistent execution of a clear and minimalist system. Success comes from the rules you follow, not the complexity of the math on your screen.